All right, in this lesson, we're going to talk a little bit about financial statements and basic financial statements that you would cover in financial accounting. We've got 4 of them that we're going to talk about. We've got income statements, statement of retained earnings, balance sheets, and statement of cash flows. Now, from a broad perspective, we talked in the last lesson about 6 categories. We talked about assets, liabilities, owner's equity. We also talked about expenses, revenues, and dividends. So those are 6. Those 6 kind of reappear in these 4 here. Okay, so let's start with the first one, income statement. Now, income statement is something that you'll often see a lot if you're managing a business. An income statement is purely a summarization of the revenues and expenses for a period. Okay, now an example of that is, let's say we wanted to show an income statement for the quarter ending 12/31. Well, the quarter ending 12/31 would encompass 3 months, and so 3 months would be 10/1 all the way to 12/31. Okay, and so when we say that we're going to summarize the revenue and expenses for the period, we try to figure out what the revenues are for October 1 through December 31st. And then we try to figure out what our expenses of 10/1 to 12/31. And we summarize that on the income statement to get typically net income and hopefully not a loss. Okay, so that's the summarization on the income statement. Now, the statement of retained earnings and the statement of cash flows kind of do the same thing. What they really do is they reconcile an account. Now, in this case, we're reconciling the retained earnings. So what we typically do is, if we're going to do a statement of retained earnings for, let's say, year 20XX, okay, we figure out what the balance was at the beginning, okay, and then what additions that we made, what subtractions we made, and then what's the ending balance of 20XX, okay? So we're just reconciling. So we might have a starting retained earnings of, let's say, $1,000, okay? And then we added revenues and we subtracted expenses and we didn't pay any dividends, okay? So at the end of the year, our ending balance would be whatever we started with plus whatever we added minus what we subtracted to get to that ending balance. Okay, cash flows, we're going to skip to cash flows for a second because it kind of does the same thing. This one right here reconciles cash. Okay. Now we reconcile the cash. So we take our beginning balance of cash, we look at our adds, we look at our subtractions, and then we get our ending balances. Okay. Now, with our reconciling cash, without getting into too much detail, we kind of divide how we send cash out and bring cash in by 3 things: operating, investing, and financing. Okay, so when we send cash out, we classify it into one of these 3 things. Maybe we sent cash out because we're buying inventory. Well, that's an operating cash outflow. Maybe we're sending cash out because we are going to pay back a loan. We are going to buy a piece of investment. Let's say we have idle cash and we want to buy an investment, so we're going to invest in something. Or maybe we're paying back a loan, and so we have cash going out because we finance some debt. So operating, investing, and financing. Again, same thing that this does, except this has to do with cash, this has to do with retained earnings. Now, the one thing that we didn't talk about is the balance sheet. This is a lot of times new. Most people don't know what the balance sheet is until they take accounting. A balance sheet, all it really does is summarize a company's assets, liabilities, and equity. Okay, and owner's equity, as we talked about in the last lesson. So all it does is it summarizes as of a date what our assets are, what our liabilities are, and what our equity is. So if we have $50,000 in cash, well, first of all, this reconciliation should say we have $50,000 at the end of the year, but then that $50,000 would also be on this balance sheet that said cash, $50,000. Let's say we have inventory of $10,000, inventory $10,000 as of the year end. Let's say we owed $5,000 to a vendor, accounts payable $5,000. And then let's say we combined had $50,000 in the company, it would say owner's equity or equity $50,000. Okay, so that's a summarization of assets, liabilities, and equity. So again, with these financial statements, we kind of go back to those 6 items. We really didn't talk about dividends. Dividends shows up here sometimes, and technically can show up here, doesn't. But we see that we've got our revenues, we've got our expenses, we've got our assets, we've got our liabilities, and we've got equity. Okay, and so we're seeing a lot of those categories right here. So those are the financial statements. Now, really, a financial statement is really just a piece of paper with things on them that summarize this. That's all it is. So think about all of these, very broadly as kind of like a bank statement. Okay, a bank statement has a summary of what's happening here. Income statement, statement of retained earnings, balance sheet, statement of cash flows. Each one would be on a piece of paper, and that's how we would get a summary of information to the users of the financial statements. Okay, so that's it. The next and last lesson we're going to talk about is the accounting equation, which is probably important, and we're going to talk about debits and credits.